You have Patrick Findaro here, managing partner at Visa Franchise. Excited to have on James Baker, CPA, specifically focused on foreign nationals and investing in the United States. James, thanks so much for joining.
Hey, Patrick, thanks for having me here. I'm very excited to talk to you today about income, state, sales, all kinds of taxes.
James, how did you cultivate your practice and really cement the niche of helping foreigners investing in the US, whether business, real estate, or other ventures?
Well, I've been doing international taxes for a long time. I started in public accounting. No, I guess it started on a cold winter night in December in 1986. I'm just kidding. But I started working for public accounting. I started with Price Waterhouse and I did International Assignment Solutions Group and I helped with doctors from the US who were abroad. And then I started working for a different regional firm. You can look at my LinkedIn, I guess. And that was all Swedish and Swiss. No, it was Swedish bankers in the US on mostly L1s and mostly L1 visas and at banks in New York. So I worked with a lot of Swedish bank executives for like 4 or 5 years. And then I worked with an Italian firm and I was doing a lot of Italians that didn't necessarily want tax residence in the US. So they would do a lot of E2s. And then in the last 5 years for myself, it's been a lot of EB2 NIWs and a lot of like professionals, entrepreneurs. There's always a lot of E2s. But I've been working with these people in the context of filing their taxes correctly, doing pre-immigration tax planning, and making sure that they understand the taxes that apply, the implications, and help them make the right decisions for themselves and their families and their finances.
From what I know, there's a lot of countries like Brazil, for example, you know more than me that basically there's no dividend tax and there's benefit, to not being a US person. But what are some countries where it might actually be better to be a US tax resident, whether that is for a year or 5 years or whatever tenor?
Well, if your country charges more taxes than they do in the U.S., then it's better to make money here. Otherwise, it's not necessarily better to overcomplicate your tax situation. But if you're coming from anywhere in Europe, basically, or Australia, or certain
Canada.
country like Mexico or certain places, like generally the taxes are higher in those countries. In the U.S., most people, if you make $200,000 and you have a family, you're paying in the low 20s. You're paying like 20% tax in the U.S. like effectively. And
And in Germany or France, it would be what, like 40% for a similar
after
type of thing?
yeah, it's way more. Yeah, and the Social Security taxes are higher. Like and so the Social Security taxes in the U.S. are basically 7%. So if you it's only up to 180,000. So if you make 200,000, you're paying like effectively like 6 or 7% of payroll taxes. The employer pays the other 7%, and then you're paying like 20% of income taxes. So it's, I guess, if you're counting all the taxes, I mean, then you have property taxes, but that's everywhere. But it's always higher in Europe. They're paying after the first 40,000, you're in like the 45% bracket in almost every country except for Eastern Europe, the
That's
Eastern
so
Bloc.
fast.
Yeah, like some of the Eastern Bloc countries have it cheaper, but it's a lot of taxes in those countries.
And when's the right time to start the pre-immigration tax planning?
Well, before you come. So the right time to start pre-immigration tax planning is before you step foot in the US. It's mostly pre-immigration tax planning, I wrote a book on it. It's called Coming to America and Keeping Your Money. I wrote it a while ago. It's an interview-based book. It's pretty helpful. But the short answer is if you have businesses and you have companies and you have significant assets in real estate or in kind of companies, then you need to do a lot of planning. If you're just a person that has an investment account, you have cash, you have a job, you have maybe a house, it's not as essential, but it is always important to have a call. Like even if you have a call with me, we'll go over it and we'll look at your exposure and what you have. And many people don't have anything to do, but if you do have many appreciated assets, like you say you bought a house 30 years ago and you've been renting it and you still own it and it's the value is ballooned. Like if you sell that once you come to the US, you still have to pay taxes in the US. Germany's a good example. If you have real estate that you bought 30 years ago in Germany, and if you sell it in Germany, there's no capital gain tax on that real estate. But if you move to the US, you still have to pay capital gains taxes on it if you're a US resident. So those are the kind of things we would review, and those are the kind of things that apply. But if you're a regular guy, you have a job, you have some savings, it's probably not that much of an issue.
And then imagine those that have significant holdings where they anticipate a liquidity event, capital gains, or they're in one of those jurisdictions where it just makes sense not to be a US person. Like, what are some of the considerations on why someone would be on an E2 visa for longer as opposed to getting a green card? And are there benefits to not paying inheritance tax? Could you walk me through that a little bit?
Sure, those are a couple different questions I'm going to answer individually. So, in short, what are the benefits of the E2 from a tax perspective? So, the idea with an E2 is if you spend less than 120 days, I know it's 183 days in a single year, but year over year it's 120 days. That gives you free access to in and out of the US up to 120 days a year, and you can still pay no taxes in the US. You technically are subject to taxes on what you earn in the US, but that's generally going to be the business that's sponsoring you that pays the taxes. And you have to structure it the right way, generally with probably a C corporation or like an LLC tax as a corporation, so you don't have to pay taxes personally on it. That's probably how we would set it up. In that case, you wouldn't be subject to worldwide taxation in the US. Most of the people, like a lot of what you guys are doing is lifestyle based, right? So it's like, it's not that you don't come to the US to save taxes. You come to the US because you want to live in the US. And it's not like, if you wanted to save taxes, you go to Panama or Dubai. Like if it's not, so it's generally not like it's a lifestyle thing, and that's great. And if you can,
different clients, I guess, those that they're coming here to make it, say 30s, 40s,
yeah,
and those that have already made it, 50s, 60s.
But then they come for their kids, right?
Exactly. You come for your kids.
Yeah, so it's you either want to be here and make money here, and I have guys who left the UK to come here, and they're like, they could go to Dubai and do that, but they want to be in where the energy is, and they want to be in the US and make money here. And again, the taxes aren't comparatively on the world stage, they're not that high in the US. And you have a lot of flexibility and opportunity to take control and do it right. And that's what I spend all my time doing. So for a non-resident, the estate tax is a different conversation because estate tax is determined by, I believe, domicile and by the location of the assets. So a foreign person still pays estate taxes if they have US-based assets, which would generally be US brokerage accounts with US stocks and also real estate, or the most common assets in or privately held companies or something like that. Those, if you're a foreign person, you still have to deal with estate taxes with US assets. Now, for foreign assets, you only have to deal with US estate taxes if you're domiciled here. And the tests for that are determined in the tax treaties and in the tax code. But basically, if you live here, then you have to deal with estate taxes here. It's just something that's not super aggressively enforced because, again, the government doesn't know what assets you have worldwide and any of that stuff either. So, and the exemption is $11 million a person. So it's pretty high also. So it's not something I deal with every day in my practice. I'm not dealing with ultra high net worth people every day. I'm more
on the... It's a good problem to have.
It's a good problem to have, but if your estate's worth more than $12 million, if you're married, $22 million, you should probably have an estate planning attorney. Like, you should probably be on that already. Like, it's not, most of the people that are watching this are like, oh, okay, now I know, and you'll be ready. But like, if you have that money, you should probably already have had this conversation. If you haven't, let's have it, but...
Well, I think you've gone through a couple of common misconceptions that like people pay a crazy amount in taxes in the US, where if you're listening from Canada, Europe, Australia, it's significantly less. What are some other misconceptions, pitfalls that you come across as people talk to you as they start navigating the US tax side before that initial consultation?
Sure. So in the US, the first thing that your clients and people who are watching this have to determine is the residency. And it's going to be like, where are you actually subject to taxes? And what visa are you on? So like student visas, your days don't count as residency here, so you're not a resident. And then like if you get a green card, you are a tax resident for the full year. Same with citizenship. So it's determining that first, and a lot of it's based on the days. If you're on an E2 visa, it's based on days, but all the other ones, EB2 NIW is a green card, so you're a resident here and everything. So the first step is determining your residency, and the next is like how you're getting paid. If you have a job and you get a W2, your taxes are very simple. And there's not too much to do. If you're a green card holder and you have a job and you have a family, your taxes you can do them on TurboTax and you can get done with them pretty quickly. It's way more complicated if you're an entrepreneur because the IRS gives you many different avenues for deductions and deferrals and saving money. And that's a separate conversation. But if you're on an E2 and you live in the US and you have let's say like a mechanic shop and you repair cars all day, there's a lot of opportunities to invest in your business, invest in your retirement, accelerate certain expenses, pay yourself certain salaries and receive different deductions from that. It's much more complicated, but there's also much more opportunity to pay less taxes than if you're just a regular employee. If you have a regular employee, your taxes are pretty straightforward.
Okay. Well, I would say our current clients at Visa Franchise are kind of entrepreneurs. They have businesses anywhere from 2 to 30 employees, and they pay themselves a salary, but there is those dividends and flexibility, I guess,
Well, it's to follow up then, there's different ways to have companies and structure your business in the US. Generally, starting with a basic LLC is the easiest because you can then choose to be elected to pay tax as a corporation or as an S corporation later or as a multi-member LLC as a partnership. Generally, for most managed businesses, like businesses earning earned income, not investment businesses or like real estate businesses, but things like where you're doing a service or selling a product, an S Corp is going to be great in the range between like $100,000 and $600,000 of profit. And then over that, potentially a corporation is better because the corporate tax rate's 21%. And these are like round rules, but those are like the biggest concepts is like starting with what kind of entity, how the entity pays tax, and then how you pay yourself from that entity.
And for the S Corp, I understand that not everyone's eligible to have an S Corp. Who can have that election? Could you specify a little bit?
Sure. So yeah, that's a common question I get. If you're a U.S. tax resident, then you can have an S Corp. Basically, if you're a person and you're a resident in the U.S., you can have an S Corp. What can't have S Corps are non-residents or trusts or foreign corporations because it's pass-through taxation intended for U.S. Like Americans to pay tax on the profits. So that's generally it's going to be a person who's a resident. And I just had a call with someone this morning who moved to the US who's seeking a visa, but they're basically on a tourist visa now. We're going to get them an ITIN and probably still do an S Corp if he's going to stay in the US the whole time anyways, because it'll probably save money on taxes. I don't know. The question for me that I have to still figure out is an S Corp is required to pay a reasonable compensation to its owner. And if he's not eligible for for employment, I guess he can get around doing that because he's not eligible to be an employee, but he is a resident. So it's fun. I learn something new every day.
Conundrum.
Yeah, it's conundrum. Yeah.
And what do you see reasonable? Is it like 4K, 5K, or does it depend on the type of business?
Yeah, sure. A reasonable compensation for an S Corp owner is to look at what you're doing for the company, what you're providing, and what another company would pay someone to do the same thing. A way we justify paying ourselves less, because I mean we're jumping around and getting into technical topics, but the benefit of using an S Corp is that self-employment taxes of 14.3% between the half as employer, half as employee. That's applied on wages, but it's not applied on S Corp distributions. So if you have a W-2 where your job pays you $200,000, you're going to have $28,000 of self-employment taxes. If you have an S Corp and you say your wages were $100 and the other 100 are distributions, you're going to save $14,300 by using an S Corp. So you're going to save $14,000 just on the same $200,000 of income. So reasonable compensation comes down to literally what it means. What is reasonable? The IRS has a whole website about it, a whole page dedicated to it, but you have to factor in all of the admin tasks you do as a self-employed person. If you're checking the mail, put that on the list. If you're making copies, put that on the list. You want to put it as much low-value skills on your responsibilities
hire an admin
as possible to justify. Yeah, you can have an admin, but you're doing it too. So to justify your lower pay. So that's like, it's a little bit. It's challenged a lot, but it's more challenged. Like the case law that I've read is like, CPA makes $800,000 and pays himself $20,000 a year on payroll. Like I've seen them go after accountants and stuff, and people that do. It's not like they do go after people, but if you pay something, making an argument over is $40K reasonable or is $80K reasonable? Like I don't see that happening. The IRS is too bogged down and understaffed to get that into the tedium. You know what I mean? So just paying something is probably going to be okay.
On that point, what should small business owners coming from abroad be really mindful of so they don't run into issues with the IRS?
Well, that's a great question. So small business owners coming from other countries to the US, you need to make sure your visa and your immigration stuff is locked down so you don't get sent back. And that's why they're working with you guys, because you're great at that. And then it's good to have some kind of tax or business advisor to at least get an outline of what you should be doing. If you're doing it yourself, that's fine. The basic thing is really to get started at least. I mean, I wouldn't do the filings by yourself, but you'll be leaving money on the table. But if you open an LLC, open a company, specifically an LLC, probably in the state where you live, use that bank account for collecting all revenues and doing all business expenses. That's like 80% of the battle. Don't run personal expenses from that account and pay yourself, transfer to yourself for your personal expenses. And that's like 80% of the battle there. The rest is the details and the compliance.
Okay. Yeah, I mean, you make it really dumbed down, but it does sound basic when you say it, but I think a lot of people don't know the rules, and they're coming from countries too that are cash-based systems. where you sell a house and there's the value on paper, and then you get also a briefcase of cash coming in, and you don't want to be doing that stuff here in the US.
In the U.S., it's mostly electronic money. I mean, there is cash, but you have to report it when you send it to the bank. But the real thing to understand is that like you have the freedom to do whatever you want. Business is quick here. You don't need invoices. You don't need. It's not formal. Someone, if I want to do something with someone, I send them money. They do what they said they were going to do. Transaction completed. And then that's the end of it. There's no paperwork. It's so quick. Business is very, very fast in the US, which is good because you can get clients fast. You deliver services fast and they're happy and you move on. So that's the big thing is there's less formalities. There's no requirement for accounting. You know, you should have your own accounting, but it's not like legally required. You don't have to tell the bank what you're doing. The governments and the banks don't work they're not in cahoots like in other countries where the banks just tells the government everything. It's not like that here. The government can get info from the bank, but the bank doesn't just tell them.
It's a legal process.
Yeah, it's legal process. Yeah, so it's like in Colombia or in the UK or wherever, the bank just tells the government everything, and it's just when something comes into your bank, the government knows, and it's not like that in the US. And then at the end of the year, they trust you to tell them how much money you earned and how much expenses you had. So it's your responsibility to be honest and tell them how much money you made and pay your taxes. And there's like no controls for it, so it's actually kind of funny.
James, can you share a case where your tax expertise made a significant impact on a client's financial well-being after relocating to the US?
Oh, of course. So it comes down into two steps. When I work with people coming in from other countries, the first step is, well, I guess three steps. The first step is explaining the concept so that they know what they can and can't do and they have a plan for operations. So the first step is really explaining and understanding how it works. The second is getting the right legal entities and the right types of accounts set up. And this could be also in terms of payment processors and how you're actually operating and getting paid. And then the third is the compliance. So often I'm working with people who find me after the year is over and maybe we make certain elections or maybe we make certain payrolls. I don't have a specific example just because I have so many and I worked with people from so many different countries. It's hard to give an example. I did to like get back to your question. I used to work with this Brazilian firm and they would send me so many Brazilians, and it's just the Brazilian system's so different, and it was so messy with how we would report things and how we'd structure things. But we would put the Brazilian companies often under S Corp, so the dividends come up tax free, and they could take them as qualified dividends. So that we do that a lot, and maybe we would oftentimes for real estate. I'm just to tell you some tricks here, I guess. For example, if you're in a country where they don't tax capital gains, you would transfer some real estate into either a family member's name or sell it before you come or put it even into an LLC. And that would be considered a step up in the basis so that your value or the value of the person who has it is much higher. So there's no tax on the gain when you sell it, or a very, very small tax. So we've done stuff like that before, but it really comes down to, it's really case by case. I don't have like a specific single example. It's really just understanding what you're doing, making a plan, executing the plan, and then maintaining compliance and making sure you're paying the least taxes possible.
And we've had a lot of Canadian clients. It kind of comes in waves, but especially during the winter months, where from what I understand, it's like the capital gains and the taxes for buying and selling real estate is pretty cumbersome. And in the US, there's benefits when you, especially I guess a primary home, on paying less taxes. Do you mind walking through a little bit some of those benefits for real estate investing in the US?
Yeah, so this applies for everyone. Real estate is if you're a non-resident and you're investing in real estate, it's a very nuanced game with many different ways to attack it, right? You have the income taxes, which are generally not that high because of all the deductions and expenses. And then you have the estate taxes, which is something that people don't think about that often, but it's really important to address the estate taxes because if you get hit by the bus, then your family has to pay a 40% tax on the value of the property before they can have access to it. And it's really serious and it's very avoidable. And I'll talk next about how to avoiding that. But to answer your question, the incentives are generally depreciation, and then we have the 1031 exchange. Yeah, that's great because you can basically buy a new property that's worth more money and sell the old one and basically not pay any tax on it. And it's a way to keep reinvesting and moving up. I'd love to comment a little bit more on the Canadian aspect of it. There are a lot of benefits in investing in real estate in the US, and there's different ways to structure it, whether it's you own it yourself, which isn't the best. Owning it in LLC, not as good, or owning it with like a tiered corporate structure, which is generally the best. It's most expensive, but the most secure for estate tax purposes. But for Canadians, it's really important when they're coming to the U.S. And here's my advice for Canadians coming to the U.S. on whatever visa, is to determine what you're going to do in Canada first, because it's really important to break residency with Canada if you're going to stay in the U.S. Otherwise, you're going to have a much more complicated situation there, and you're still going to have to pay taxes here. And the way that Canada sees LLCs is different from how they're treated in the U.S. So if you have an LLC here, Canada looks at you as a corporation. So money you take from an LLC isn't taxable to you, but Canada sees it as a dividend. So there can be a lot of issues. Like, for example, if your LLC, if you're Canadian and you have an LLC and you're in the US, but you're still a Canadian tax resident, and you just make a regular LLC, you make $100,000. You leave it all in the LLC, that's fine. You pay tax on it in the US on that year. The next year you take the money out, then you have to pay tax in Canada on the same money the second time. So it's really important to get good advice if you're still paying taxes in Canada, or if you're a Canadian with U.S. investments, because it's very nuanced, and the entities are treated differently in both jurisdictions. So it's really tricky.
James, over the past few years, how have you seen these tax laws or regulations change?
That's a good question. In 2017, the Tax Cut and Jobs Act made it more complicated for Americans who had companies abroad. So it made it more complicated. I know that's not generally the audience that we're talking to today. But in the last couple of years, it's really been about information reporting and disclosures, but things haven't changed too much. It's more about modernizing the sales tax system, and that's with the states. So if you're selling products into the United States, whether you have a U.S. company or a foreign company or whatever, if you're selling into the U.S., you're probably subject to sales taxes at those states. And it's basically like a VAT, or if you're Latin, a IVA, and it's basically based on the value of what you're selling to people who live in the U.S. And that's something you would inevitably charge to your clients in the U.S. and they would pay it. But there's been huge advances in that since 2018, the case of Wayfair versus South Dakota. You guys know Wayfair, the furniture company. They went to tax court in South Dakota. South Dakota won, and all the other states adopted it. So that's what happened there. And then everything else is more about updated informational reporting. But as far as like the core tenets of the tax law, nothing's changed in the last 5, 6, 7, 8 years, other than like obviously like different nuances, NOLs. There's things that change every year, but nothing in terms of like who pays taxes when and where.
And for your clients that are scaling up their businesses, like, when does it make sense to, you talked a little bit about the tax filing and structuring side, but how about like more ongoing support? When does it make sense to sit down quarterly with a CPA? When does it make sense to bring in that bookkeeper? Where do you see that in terms of like the business evolution?
Sure, that's a good question. So when you're starting a new business, the first thing you need to get I would say the first thing is to have your minimum product. You need to make some money, right? And you need to be making money doing whatever you're doing. And as you're scaling, you have different problems and you have different things you need to measure. If you don't know where your money's going, you're going to be wasting it and losing it. And generally, a good tax accountant, there's different types of accountants, right? There's bookkeepers and people who just get the numbers organized for you, which is really good. And you should know what you're thinking, where your money's going and why you're spending it. And that way you can see where you need to cut or see where you have room to spend more. But then the tax advisor is going to help you keep it all at the end. Because if you think about it, the highest tax rate in the U.S. is 37% for a person. That's your biggest expense if you do it, especially if you do it wrong. So if you make $1 million, $370,000 to the IRS is your biggest expense. So it's something you want to make sure you invest in. And my biggest advice here is do it before the end of the year. If you had a good year, you're obviously, as a small business owner, you're probably super busy because you had a really good year. And you probably don't even have an accountant or know your numbers. Many of my clients are very successful, but they're so busy they don't deal with this stuff because they focus on making money, fulfilling services. And I'm the same way. My accounting's a mess. I'm just kidding, but I have to do some work on my accounting still. But yeah, so I would say make sure you do it before the end of the year. You miss out on a lot of deductions and opportunities for things to reduce your tax bill if you do it after the end of the year. When people call me in January or February, there's like only so much you can do. So I don't know if I answered your question because I kind of got off on a tangent, but it's important. When do people need an accountant is what you were saying, right?
Or I guess like as you scale up the business operations, like when would it be advised to have that bookkeeper? But you kind of answered it. And
so the short answer is once you're making over a couple of $1,000s a month, it makes sense to have a conversation. Once you're making tens of thousands a month, it makes sense to have someone that you work with, like that you locked in with. And then you should talk to them before the end of the year. If you're not making money, you won't pay taxes. So it's pretty easy. It's just at the end of the day, the tax is on profit. So if you have a business and you're struggling, then you need to do it. You need to do the compliance, but there's no opportunity to save taxes when your bill is zero. So that's my advice. When you're making a couple thousand a month, a conversation is a really good idea. A couple combos if you want to talk to different people. And then when you're making tens of thousands a month, having someone locked down, having a plan is really important.
I like that. That's a good takeaway. And I'm sure we could have another conversation on this next question, but like there's a lot of benefits for retirement savings that I don't think other countries have as much. Could you talk a little bit about that for your entrepreneur clients? How just maybe an example or two and how much they're able to put in a retirement savings account tax free?
This is a good topic. So when we're talking about retirement savings, there's a couple things to consider because when you are contributing to a retirement account, you're deferring your tax. This is U.S. source income. So when you make these payments, when you make the distributions later, it's subject to tax. So if your plan is to stay in the U.S. for 8 years and then leave, it might not make sense. Because then there'll be withholding taxes, there'll be complications, you'll have to pay tax on this later in the US and maybe in your home country. It might not be worth it, depending, it's a conversation to have, right? If you're at the highest marginal rate and you live in California, you're at 45%, it's probably still good to put some into retirement and then defer it for later. But, if you're only gonna be here a couple years, it might not make sense. That said, if you're like, I love America, we're moving here, the kids are here, we're staying, welcome. First of all. Second, I'd like to say that there are different opportunities. So if you make $100,000 a year, you can open a single, there's many different 401k plans, which are called defined contribution plans, which generally you can contribute into 55,000 a year on these. It goes up every year and it's in the 50s as the most you can contribute to those based on your income. So you need to make about $200,000 of profit and then you can put in between yourself and your company about 50,000. And there's there's SEPs, 401ks, solo 401ks, simple plans. There's a bunch of different plans you can read about on the IRS website. Those are all defined contribution where we just see how much you can contribute. Then when you're making a lot of money, they have defined benefit plan. And a defined benefit plan is really cool because you can put in $300,000 into retirement. And when you contribute that, it's an expense for your business, but it's still your money. So basically you're saying, don't tax me on this 300,000 now. I'm going to let it grow. I'm going to invest it for 30 years until I retire. And then I'm going to take it out and pay tax on it then. And, it allows you to basically invest tax-free. You're investing tax-free all the money and you only pay tax when you take the money out when you're retiring. And these are determined based on your wages. It's a complex calculation, but it's based on how old you are and how much money you earn. And it's generally for people making 500,000 plus. If you're making around 500K net income in your business, not including your pay, that it might make sense for you. But it's basically 500K and up. A defined benefit could be a really great option to really ram up your retirement savings. And then you can use those savings to invest in your own future ventures. There's a lot of tricky stuff you can do with that money in the future.
Yeah, we see that structure in Silicon Valley in terms of these tech investors just keep on investing in the different plans. Deferring.
The best was Peter Thiel, I think, was the guy who put all his PayPal stock in his Roth IRA. And it's not even subject to tax. It's growing tax-free and distributable tax-free when he retires. It's an insane amount of money, but yeah, that's some of these guys are really smart. Again, you have to, once you're making a lot of money, then you have a lot of opportunities and options.
James, is there anything that we didn't talk about today that you think would be relevant to the Visa franchise audience?
I guess I'll do a general recap for the audience. And this is really important because the idea is that I want you to come to the US without fear of the tax man and to understand the idea of what's possible, what you can do, and what you have to do, right? So the first thing that's most important when coming to the U.S. is reviewing your visa and the residency implications of that. How many days you're in the U.S. and what visa you have to see what kind of taxes you have to pay. And generally it's going to be, if it's in E2, it's less than 120 days year over year, there's no taxes. If you're living in the US basically more than 183 days on any visa, you're basically, except for the student visa, you're basically a US tax resident. You tax on your worldwide income. You have to report all foreign companies, all foreign bank accounts, and disclose that, mostly informational stuff. That's the first thing, is determining the residency. Once you figure that out, you have to review your pre-immigration tax planning to see if you have many assets assets, which are companies or fixed assets or real things that you own outside of the US, it's definitely important to have a call with someone before you come to the US. So that's really important. For most people, if you just have cash, it doesn't really matter. The next thing is going to be determining when you're here. So if you're a business owner and you're coming here, your immigration attorney is probably going to set you up with some kind of LLC. I would recommend when you're an entrepreneur and you're running a business, use an LLC just as a default, and use that for all income, all expenses, and keep all your personal stuff separate. And then before year end, before in September, October, November, December, good luck getting a call with me, but find find a knowledgeable tax planning CPA. And obviously the level of your income determines on the level of necessity of this. If you made 20 grand last year, then it's not that important, but you need to know how much money you made. So you probably need an accountant before that to know how much money you actually made so that you can do your tax calculations and your planning before year end. And then after that, all of it's about just maintaining compliance, filing all your annual forms, generally due before March or April 15th every year. The tax year is January to December 31st. And there's a lot of opportunities for savings if you're making some money. You just have to do it before year end. And I think that's probably it. I mean, the rest of it's all estate taxes and nuance and stuff like that. So making sure you have a good immigration attorney in the first place. I guess that was step one. Make sure you have a good plan, a good immigration attorney, and you have the right franchise you're setting up so that you are.
We can work with our friend Joaquin Rosales, who we've had clients with.
Exactly. You can find the right franchise with Patrick, work with Joaquin to do the paperwork, and then I'll help you pay less taxes. We have a little trio over here. So yeah, it's good to have that all set up. So I think that's it. I could talk about this all day.
Well, James, we'll be sure to include a link to your YouTube channel. Is there anything else that we should include?
No, James Baker CPA. I talk about international taxes, and happy to be here and talk about this stuff. No, I have James Baker CPA. You can find me on YouTube all over the internet. Happy to be here, Patrick. Thanks for inviting me on, and I'll have you on my channel next week to tell my audience about the Visa franchise. So if you're here and you want to watch Patrick on someone else's channel, you can do that too.
Thanks so much, James. Really appreciate it.
Okay, thank you.